Are you tired of the emotional ups and downs of day trading SPY? You're not alone. Trading SPY can be exciting and rather profitable with the right approach. SPY or SPY is an ETF, an exchange traded fund that mirrors the S&P 500 basket of stocks. And traders like to trade it because, well, it's highly traded, which means it's very liquid. Meaning you're not going to get stuck in a SPY trade so easily because there are plenty of buyers and sellers. And the great thing about this is the options are also highly liquid too. And the fact is, less than 10% of day traders actually make money. And that's not SPY's fault. The number one factor that tends to lead traders to failure is emotion. There are two other factors that I also believe are prevalent within failed traders, and that is not having a plan or following their plan and overtrading. The thing is, we're still looking for high risk, high reward trading like day trading with fewer of the downsides. This is why I like SPY T trading. It's an aggressive overnight swing trade in which we only trade once. Rather than going after little wins, we're going after one big win. An overnight swing trade trading the overnight gap. You've seen it. The market closes at one point at the end of the trading day and opens up either up or down the next day. By doing this, there's only one trade, and because there's only one trade at the end of the trading day, there's nothing we can do after the market closes. In other words, taking the emotion out of the equation. Another nice thing about SPY T trading is that you'll never lose more than you put in, and your profits are unlimited, as high as the market can go overnight. It is a numbers game, and of course, when you're a high risk, high reward trader, you know you can lose principal in our trades, but we're going for the long term. And we figure we need to be correct about 55% of the time or better. Where do I get 55%? Take a look at this chart. This chart is based off of the S&P 500, which started in 1993. And if you had bought SPY in the morning and sold it at the end of the trading day, well, you probably wouldn't have made very much at all. However, if you had bought SPY at the end of the trading day and sold it in the morning, well, you'd be up over 1,000%. That tells me the action is overnight. But when you look at the chart, you realize that you only win when the market goes up and you lose when the market goes down. So how do we get 55%? Well, the market actually went up about 54% of the time during that time frame. So if we can do better than 54% by focusing on both up and down and maybe winning 60, 65, 70% or better, well, you can do the math. And that's trading with stock. Imagine amplifying it with options. So you know to buy your options at the end of the trading day and sell in the morning. But then the question is, what direction do you point? Well, the good news is there's a free signal at spytomorrow.com, and it's available at 4 o'clock Eastern Time each trading day, and you can base your trade off of that up or down signal absolutely free. What our algorithmic signal is doing is measuring what we refer to as the pressure at the end of the trading day, which often correlates to how the market might open the next day. Now here's the good news. You can see how well that signal is doing on the front page of spytomorrow.com because we keep an archive of our last 20 predictions for you to review. Now while you're reviewing, always make note of something that we should always make note of, and that is news. News can certainly change the mood of the market. So if you see some wrong days, maybe take a look and see if there was an earnings surprise that moved the market, or a government report such as PPI or CPI, or even a jobs report. It happens. There are many ways in which you can trade this signal and the overnight gap. You can trade stock, you can trade ETFs, you can trade leveraged ETFs such as the TQQQ and the SQQQ, depending on if you want to go up or down. Or you can trade options. And there are a few ways we like to go about it. The nice thing is you can decide how aggressive or conservative you wish to be in your overnight trade. Especially when dealing with options, you can decide the date till expiration. You can do 1 day, 3 days, 5 days, 7 days, and the further out you go, the more conservative you're going to be in your overnight trade. It also limits the amount of upside, but it also minimizes the amount of downside. But if you're highly aggressive, you can consider 1 day to expiration, which can leave you with some really great profits or maybe losing half your money overnight. I generally recommend that you use your high-risk portfolio, not your savings or your retirement money, Roth IRA, but a designated high-risk portfolio, just a small percentage of your overall portfolio for high-risk trades. And you have further control over your trade based on your risk tolerance and the position size you wish to risk. Maybe it's 2% of your portfolio, 5 or 10% if you're highly aggressive. And there are times you're not sure which direction to point. Maybe there's a big government or earnings report coming out before the open the next day. Well, you can consider the signal and maybe other signals along with it and maybe point one direction using a ratio trade. There are a number of approaches to a ratio trade, and I have other videos that I recommend you check out as it relates to ratio trades. But basically it means you're leaning 2 to 1, 3 to 1, or 4 to 1 in favor of your signal. But that 1 is a hedge, and that hedge can support you maybe to not lose quite as much money if the market turns the other direction, or quite possibly make money the other direction, let's say if the market totally crashed. So there are 3 parts to the thisThe trade, and obviously trading skills are important. Knowing when to buy is important, but even more important is when to sell, and that quite honestly makes or breaks many traders. You have to learn how to sell or exit your position well. So that's going to take some time, but you can certainly paper trade beforehand just to get the hang of it before you start putting money into the market. There are 3 parts to the thisThe trade, and the first is the short-term overnight swing trade, trading the overnight gap. The second part is the pressure reading. Is the probability that the market's going to go up or down, and how much of a probability? You can get into those numbers if you wish to become a member, but right now just focus on the up or down. And then the last part is the type of trade. Is it a stock trade, ETF, leverage ETF, or is it a directional options trade, or perhaps a hedge trade such as 2 to 1? As we like to say, SPY tonight, profit tomorrow. I'll see you in the next video.